So I guess we'll go through a little bit of housekeeping. First, a little bit about us. Again, my name is Daryl Patten. I am a consultant here at Fort Pitt Capital Group. I've been with the firm about 23, working on 24 years. Prior to that, I was an executive at Charles Schwab and Company, and I have a collective experience of about 35 years in the business. Really, I love my time here. I love what we do for our clients, and I'm excited again to hop into our topic today. Roman, why don't you tell us a little bit about you?
Absolutely. Thanks, Daryl. My name is Roman Dale. I'll be one of your hosts here throughout the day as well, and I'm an advisor with Fort Pitt Capital as well. Been with the firm here just coming up on a year, in the industry for about 6. I had started on the institutional side, been working on endowments and trusts, but I've been excited to be with Fort Pitt here with these continued offerings to help clients navigate topics like insurance that we look forward to diving more into today.
Great. Ari, can you share a little bit
Sure.
about you?
Yeah, Ari Fischman. I'm a certified financial planner who's really hyper focused and specialized on insurance for over the past 20 years, specifically within wealth management firms to make sure that the insurance piece is really in line with the overall financial planning collectively in a consultative matter that really fits within the profile of the clients, not just when they purchase the insurance, but as they grow and develop and their needs change.
Wonderful, wonderful. Well, a little bit more housekeeping. Roman, why don't you walk us through a little bit of the tech housekeeping and how folks are going to interact with our event today?
Absolutely. We encourage everybody to interact, and we hope that this could be as close to a conversation as we can have anywhere else. There are 2 ways to interact, whether you're on a device here today, and you'll notice you can tap your screen to ask questions or get the handout that follows the PowerPoint. You'll see a Q&A icon at the bottom of your screen. We encourage you to type in with any questions, and we'll get to those as they come up, as well as in our Q&A session here to close. If you're joining on a computer, you'll notice a Q&A icon as well, bottom of your screen. Encourage you again to ask anything that comes up topically, and we'll do our best to answer that.
Great, wonderful. I guess this slide brings us to our topic for today. Before we jump in, I do want to talk a little bit about kind of provide an overview and a little bit of content here. Ari touched upon it in his description of what he does and how he approaches the interactions. We're going to talk a lot more about that in today's session. But one of the words that Ari used was consultative and a consultative approach. And I think that is very, very key. You're gonna find out about more about how we and Telemus and our partnership approaches situations. When we engage with a client, oftentimes the insurance is already in place. We're not here to sell insurance. We're not here to place insurance. We're here to help clients integrate and organize their insurance. So really what our jobs are is to help clients. Not only do we just help them with investments and manage their investment portfolio, but we also help them organize their financial life. And what that includes is estate planning, taxation, again, retirement planning, investment planning, and last but certainly not least, is investment services and insurance services and insurance planning. How do you ensure the investments and other parts of your life, like income stream, that are needed to complete a full financial organized picture around you? So again, that is really the key term is consultative. We're going to talk a lot more about that during today's session.
So interesting enough, before I started working with Telemus, I had my own insurance practice for over 10 years, but in 2014 partnered with Telemus because they really struggled incorporating insurance within the overall financial planning process prior, and they wanted to bring in the service in-house so they could offer an expanded resource for their clients. And it's been a tremendous value add service because when you really think about it, all of our clients have insurance, all of them, whether it be home, auto, life, disability, they all have them. And what we've found is that most people have purchased it by it being either sold to them without really thinking about how it fits into their whole picture, coordinating with their financial planners, maybe their estate planners, maybe their CPAs, and bringing it as a team approach as far as what is the whole story and what makes sense. And when we gather all the insurance documents that a client may have, 2/3 of the time, we find that they're overinsured, underinsured, insured inefficiently or ineffectively. And our broad job is very simple. It's really just to work with the advisors, get an understanding of their financial plan, and make sure that whatever insurance is in place going forward is what makes sense within their overall plan, regardless of what has been purchased in the past.
Sorry, why don't you tell us about the types of tools you have in your toolbox?
Yes, absolutely. So there's obviously touched upon the various types of insurance here, but in the life insurance world, we really have no loyalty to any one company. So what we're looking at is what they have in place and doing an audit on, making sure that if they have life insurance to protect young children, that they're not spending too much money for those coverages and they have the right features in place. If they have permanent coverage, we're looking to review that and see if it's the products that make sense long term and they're for where their needs are today compared to where they bought. Disability insurance, very basic, protecting your income while you're working. Many times you have some coverage for work, but it's just a gap in terms of where your current earnings are compared to the private insurance you got purchased on your own. Property and casualty could be home, auto, umbrella. We're all licensed here on my team, but we don't sell this insurance directly. What we do is we partner with other agencies. So we'll look at the coverages and identify gaps such as water backup or coverage amounts that are not in line with increasing costs of reconstruction. And if we identify those gaps, we'll just bring them back to the clients and say, hey, you could take it back to your existing advisor, or we could find someone else that could help you, whatever your preference is. It doesn't matter to us. And liability, just making sure that as your net worth grows, you become sadly, a bigger target for potential liability. So if someone gets into an accident and it's your cause, the first thing that any plaintiff attorney is going to do is going to Google the person and see how collectible they are. The bigger the occupation, the bigger the liability. So we want to protect your net worth with appropriate liability coverage along the way. And that is for pennies on the dollar.
Great overview. Thank you so much. Thank you so much. So, all right, we have a client and, we are taking them through the planning process and we then approach insurance. So we ask the client to start to collect their information and we bring you into the fold for consultation. Can you tell us how this consultation look? What's the process and what should clients be prepared for?
Right, yes. So the first thing we really want to do is just understand what the client's current situation looks like. What actually, if they didn't have any coverages, what should they have? That's the first thought process that we're starting with. Then we're gathering everything that they do have and saying, how can we work with what they have to make sure that it's the most efficient and effective way to accomplish their objectives that we've defined with the advisor's description of the client. So the goal is really to make sure to leverage the insurance products that they've purchased in the past when they are good products and make sure that we keep those. But if we find gaps or products that are not suitable, to either eliminate them or replace them. But really it just starts with the financial plan and working with the advisor and the client to understand the objectives and what they have in place and what actually needs if we were going to start from scratch, and then how to leverage what's in place to see what should be kept, replaced, modified, or updated. And that's with gathering all the statements of everything they have from the insurance portfolio.
Great, thank you. And I think that's a key ingredient. You touched on something really unique there, and that is, listen, if it ain't broke, don't fix it, right? If there's a policy there that's good, and it is meeting the needs and it's at the right price, the right dollar amount and positioned well, it's something you're going to recommend to keep. We don't need to replace something that's working for them. And that doesn't happen a lot in the industry. So we really like that approach. I know I've brought clients to you where that has been the exact recommendation is keep it, it's good. And we can really appreciate that. So thank you. So let's talk about ways and drill down on this a little bit more. When you do find clients that you can help, what are the things that oftentimes you feel are issues that you uncover or obstacles that you can help them overcome, or just ways you can improve their situations? What do you find most often?
Yeah, absolutely. As clients mature and they develop and they've obtained more policies over the years, a lot of times the older policies aren't necessarily revisited. So for example, sometimes trusts are created that should be the titles for all the life insurance policies in particular should be owned or the trust as the beneficiaries. And those trusts were created and were meant to be funded. It's very common that they are with new policies shortly after those trusts, but it's also just as probably more common that the old policies are ignored. So it's to make sure that just on a very structural basis, that first, if any policies that exist, that they're actually set up appropriately, that they have the correct beneficiaries. Maybe there's divorce, maybe there's adult kids, maybe they named minor children. I mean, that's something that we really don't like seeing as within policies. And then we're looking at the biggest liability side. And that's really we touched upon this. Umbrella policies are pennies on the dollar. What are the most likely claims? It's water. Water is the worst, most often claim within home insurance. So do you have the proper water and mold protection within your policies? And do you have the limits in line with the updated cost of construction? So those are areas which we're just making sure that the proper insurance is placed. And many times it's not spending more money. It's just repositioning existing policies to make sure that they're appropriate with the current needs and you're not over or underinsured or insured inefficiently or ineffectively.
Great. Thanks. Yeah, in fact, we just did a review for a client with you with the firm a week or so ago, and the first thing that was uncovered was this is a physician who is preparing to retire, and his parents were still listed as the primary beneficiaries on the insurance product. It's just what happens, right? As we buy these policies and then put them in the safety deposit box. So it's a great point. Well taken. Next, term insurance. We often think term is pretty straightforward. Is there anything you can do to assist with anyone that holds term life policies or a policy?
Yeah, this is actually a really common one. It's a misconception that we put down here because it's a common misconception that when someone obtains a term insurance policy, the pricing, because they bought it 3, 4, 5 years ago, is going to be better than what something new might be, and that it would be a good value. So there's a lot of areas. First, did they get approved at the best health rating? Maybe their cholesterol was 204 on the total cholesterol. And now a lot of insurance companies would give best health rating if they have good ratios where they didn't in the past. The other thing that's just, if you think about it logically from a pricing perspective, if you buy a 20-year term insurance policy when you're 40 years old, you have the coverage till you're 60 years old. If 5 years from now, you're still in good health, and you wanted to get the same amount of insurance, but for 15 years, many times it's cheaper because less people are going to pass away who are in good health from 45 to 60 than from the person who bought the policy 5 years earlier from 40 to 60. So a lot of times, similar to the mortgage industry, it makes sense to sort of refinance your insurance. And then once you're doing so, making sure that if you're replacing anything, that obviously it matches with whatever your current needs are, whether they be less, more, or the same. And then just features within the policies. Most riders within policies are a waste of money, with the one exception that we believe is very important, which is convertibility, which basically means that if your health turns for the worse, you have the ability to change to a permanent insurance at the health rating you got the term policy without reproving your health. And the reason that's important is typically it costs about 10% more, but after over 20 years and managing a couple $1 billion of insurance, we've seen clients use it many times, that convertibility. And if your health turns for the worse and you have that option, it tends to be an asset that clients want to utilize. And then a lot of times when we're doing this within term insurance, where the refi is just saving money, apples to apples.
Great. Thank you. There's some really good information.
Yeah, absolutely.
In that last statement. So thank you so much.
Absolutely. And thank you, Art. And even for those joining us on the call here today too, it seems like term insurance often gets put in that bucket of, set it and forget it. That once you bought it, there's no way to revisit it. And even we had a chance to work with a young couple a few weeks ago that, by nature of family planning, decided to expand their term coverage and revisit what they had, expanding their family, or actually able to find reduced premiums with better coverage. So it's a topic I think we're trying to encourage more and more. And now that we have the offerings to save, actually save on premiums and offer better coverage for clients. So it's a great conversation.
Awesome. Fantastic. So whole life insurance. So client has a whole life policy. They already purchased it. They're coming to you to review it. What can you do to help?
So we always need to start with, in a sense, first of all, the financial plan, understanding what the desire for that asset, because it will likely have cash value, is going forward. Do they plan to need the money for their retirement life? And if so, what would be the best way to access that money, whether it be the existing policy or something different? Whether it be for legacy for their kids, and if so, does that whole life policy provide the most efficient way to get to the highest legacy amount at their life expectancy? Sometimes it does, sometimes it does not, but we would do that analysis. And a lot of times whole life policies are very common inside of an estate. And as for high net worth individuals, that could become a potential problem. So we've had a lot of cases where we've, in a sense, stripped down the value of the whole life in the estate to obtain new coverage out of the estate, which is an incredible difference in the net amount that goes to kids. So it really just a matter of, it starts from scratch. What is the objectives today based on all your other assets and what you need in your retirement and or legacy objectives? And then based on those objectives, looking at the asset and trying to figure out what's the best use of that asset. Keep, modify, or replace.
Wonderful. Wonderful. Thank you. So disability. Where does disability insurance fit into the overall picture?
Yeah, so disability insurance, I gotta say that this is something that we've had a lot of claims with. Most people start with life insurance in terms of the planning side, but we've sold probably 10 times more life insurance over the years as disability, and we've had a lot more disability claims than life insurance. And a lot of a common question is that we get, and there was a similar question that was actually posed prior to the webinar, is as you get close to retirement, do you need the disability insurance anymore? And many people start to want to drop it because they've been paying into it for 30 years and they feel like it's a waste. And I will tell you this, that we've retired multiple individuals by going on claims that they did not realize that they were eligible for because they're not at full capacity anymore, but they were working full time. But I could think of a dentist as an example that every night would come home and take painkillers because of the procedures they were doing every single night. It was documented. And the doctor's like, well, the only way to solve this is work less. Guess what? He finally started to work less and went on claim. And he was on full claim for 5 years and basically retired at 60, owning his practice and collecting disability benefits. There's a lot of examples that we've given where people are struggling through ailments and problems that slow them down, and they may be eligible for claim and they don't realize it. So it's something that has to be looked at. And the one thing I stress so much, because we've helped so many people where they're just about to drop their policies, go on claim, is if you're getting to that point of retirement, do a full executive physical prior to dropping your disability insurance, just to make sure that there's nothing wrong with you that you may not be aware of. And at that point, if you're going to retire in the near future, and you're in tip-top health, congratulations, that's a wonderful thing. Then you could drop the coverage. But it's a valuable coverage, and most of the claims happen on the back end of your career, which is why I keep stressing that situation. And we're happy to help as needs come in.
Great advice. Great advice. Great thoughts. Listen, home and auto coverage, as financial planners, as investment folks, and as we're putting the mosaic together of full financial planning for clients, we often don't think about including and focusing on home and auto coverage. Obviously, you do. Tell us about that.
Yeah, so we're not looking to necessarily replace any insurance agents that are doing the home and auto for you, but we do want to make sure that you're fully protected. And a lot of times when we review these coverages, we're finding that clients don't necessarily have uninsured slash underinsured in coverage, which basically means if you get into an accident to someone else who's not insured appropriately, they're very difficult to collect from. And having that coverage and the overall liability coverages is critically important. So teenage drivers, nannies who are driving, there's a lot of questions that come up along the way, but just making sure that over a few dollars, you don't stumble upon a big potential claim that could, be a dagger in your financial plan.
Absolutely. Yeah. Thanks for highlighting that. Those are things we don't think about from our seat sometimes. So great point. Annuities. This is probably one of the most common scenarios that we see at the firm. Obviously, we're onboarding a client, a new client is coming to us. We're asking them to collect all their investment documents along with holdings, and inevitably most folks bring an annuity statement or two to us. So clients own these, they bring them to us, they want our thoughts and help on what to do with these holdings and these assets. And obviously what we see a lot of, quite frankly, is an investment or an annuity with poor performance and a very low tax basis or a very substantial tax event if we make a change. So sometimes we feel like our hands are tied and they're difficult to work with. Obviously, oftentimes the poor performance comes from high fees associated inside of those annuities. It can come from lack of really substantial or quality investments inside of the annuities. And the low tax issue isn't because they've had this great return. It's just because they were sold. A client was sold this product and they've wanted to stick with it. They believed in the sales pitch, so to speak. And they want to stick with it. So they've held it 10, 15 years. Over that time, it's not done a lot, but even something that's not done a lot over that time period can generate substantial tax implications if you're not careful. So we see this a lot. We want you to talk about how you help clients and really what you dig into when it comes to annuities.
Yeah, there could almost be a presentation in itself on all the experiences that we've had upon annuities. But said simply, actually are a lot of really good annuities and really bad annuities. They're all over the map. But as Daryl mentioned, that unfortunately most annuities are sold and not purchased as part of an overall financial planning perspective. And most annuities that we see are in non-IRAs. So they're your after-tax dollar investments. And as those investments grow, you're not paying taxes on it till you take the money out. So it becomes this in a sense, a tax trap that you will pay ordinary income tax on every dollar of gain when you access the money. And clients really don't like that. But if it was used as a retirement vehicle, then you should be accessing it at some point. So it's trying to figure out what makes the most sense. But one thing that we've come across and we've been really successful with these situations is looking at long-term care insurance, because long-term care liability is become a very significant liability, especially for home health care for clients. The cost of care and health care is going up at way past inflation rates. So it's a gap that could exist within financial planning. And sometimes in these annuities could be repositioned into annuities with a long-term care rider that serves as a multiplier of benefits. So if you have 100,000 of annuities with 50,000 of taxable gain, you could potentially get 300,000 of long-term care benefit that could be accessed tax-free if you're used for long-term care. So it's a good way to using a tax, an inefficient tax vehicle to potentially a very tax efficient long-term care protection. And one example, just in the healthcare industry, I unfortunately sprained 2 ligaments 10 days ago playing basketball, and I have surgery Friday to take care of it. I just got my assessment, and the cost for the surgery for being in a surgical room for probably less than 2 hours will be $55,000. That's where our healthcare system is, and that's so protecting for long-term care when you need care every day. could be a potential major liability. And figuring out what assets to use to protect that is a very important part of planning.
Fantastic. Thank you. Thank you. Yeah, I think the repositioning into long-term care potential benefits is a crucial. A lot of us don't think about that, and I think bringing that expertise in to guide folks through it is extremely value added. So thank you. Thank you. Great. Roman, next slide. All right. Maybe we'll have you introduce your team.
Yeah, I'm leading the team, but with the integration of the partners that we're working with, there's no way I could do it on my own. So we really take the client experience, the advisor experience, very, very seriously to make sure that everyone is getting the appropriate solutions that integrate most effectively within their plans. So I've been doing this since straight out of college, almost 25 years now, which is crazy. Todd has been doing this for over 30 years. He's been an amazing addition over 2.5, 3 years ago that he joined the team. Gordy is a financial advisor converted into an insurance advisor as we needed more help out of Chicago. That's been a great asset to the team. And Kristen and Victoria are basically handle every service application need that may come up operationally. We go for a process that makes sure that clients know what's going on every step through the process of whether auditing coverage or new coverages. And we don't like it when they're calling us to ask what's going on. We're a very proactive firm to make sure that the experience is really high end every step of the way, and wouldn't be able to do it without the whole team.
Wonderful. Thanks for the overview. So I guess we will transition at this point into our Q&A session. So folks, we have kind of a combination of questions that were submitted during the registration process. So we have a collective list of those. We are also starting to gather questions live real time on this venue that we have access to as well. So if you do have questions now, please do submit. We can see those and we will address as many as we can. So, all right, what I'll do, I'll start with the first question. We'll start easy, then we'll work to the harder ones if that makes sense. But what is the most common misconception people have about insurance?
The most common misconception is if they've purchased things from years ago, it's going to be better and more cost effective than what they could get today. Many times we're actually saving clients money through our audit process without sacrificing coverage.
Great. We talk a lot here about being comprehensive planners, right? So having insurance as part of a comprehensive, holistic financial plan. How does insurance work as a part of that broader plan, all right?
Right. A lot of people when they're younger, they don't really have significant assets. So their insurance needs start very basic. As their assets grow, their liabilities potentially could grow at the same time because their cost of living has gone up a lot, but their assets grow at the same time. So in the review, we're working very closely with the advisors to see how much their assets could offset the needs for protection on the liability, so we're not over-insuring clients. And then at the same time, what gaps based on their updated spending and liability side do we need a bridge because of their financial life has really changed a lot over the years.
Yeah, absolutely. Thank you.
Great. So I'm going to read a question that was submitted during registration, and then Roman, I'm going to transition it to you to maybe read a couple real-time or ask a couple real-time questions from the board. So the next question is, at age 74, I have $1 million life insurance policy with about 2.2 million in CSV. At what stage do I cash it in and use the proceeds for investments? I have about $8 million to pass on to nieces and nephews already, and have about $200,000 to live off of annually, and more than enough LTHC and no debt. So there's a lot packed into that question already.
Yeah,
you can break it down. Yeah,
it's a fantastic situation to be in. And the need for insurance, the actual need from the insurance sounds like it doesn't actually exist. So what it comes down to is he referenced the asset. The CSV is cash surrender value. That's literally an asset that could be repositioned. So the first thing we are looking at within that cash surrender value is what is the cost basis? What is the cost basis on that surrender value to know the tax exposure if you want to utilize it for your own life, how to best access that money net of taxes. Then we have a lot of different ways of managing that well. And then the second thing is objectives. Like, is it really, you don't need it for the investments. It sounds like you have enough assets to cover your cost of living that on that side. You have nieces and nephews, maybe you want to pass it down. Do you have any other objectives for your legacy? Because ultimately someone's going to get all of your money. So almost bucket strategy. How much goes here? How much goes there? How much goes wherever, charities, organization. And once we have that organization of what we need to live off today, what we want to pass on, then getting strategic with all of the assets to decide what should be spent down first, what should be tapped, what should be kept, what should be earmarked, and for where and how. So I'm not answering the question, it's vague, but it's a very personalized, direct question. It's a great one, but it involves some planning.
Roman, why don't you share one of the real-time questions?
Absolutely. We'll go to our real-time Q&A here. We thank you all for submitting questions here as well. But if somebody wants to do a review here, what's the cost to use your service?
It's a great question. So most of the time, almost exclusively, the cost is just built in through being a client of the firm. So it's one of the value add services just from being a client of the firm, and having fees collected from assets that are being managed. Sometimes when we are recommending transactions, commissions are being paid to our firm, which is shared, but we look at ourselves as the advisor's client first to solve the problem. We're not looking at transactions as a first part. We're looking to utilize what's in place first, and then when transactions make sense, work on it, and then those commissions are being paid. There are some scenarios where clients have asked us to be truly objective and just offer our opinion only. And we have at times engaged in fee-based planning that's hourly based on scope, but very rarely do we utilize that because most of the times it's value add just for being a client and understanding that we're really not looking for transactions. We're looking at figuring out what makes sense and going from there.
Yeah, oh, that's great. And I'm sure helpful for folks here to know as well. And building off that too, we have a question here. What should I do with my policies as I approach retirement?
Yeah, that's a great question. So the needs for income replacement as you typically approach retirement doesn't exist. So a lot of times we look at the total insurance spend and see if there's any protection need at all. In terms of disability, we talked about it, just doing a full-fledged executive physical before you drop it. And if there's legacy-based policies, universal life or whole life insurance policies, have an exact same conversation we did for the 74-year-old that we mentioned prior. Term insurance, we typically look to unwind. Sometimes the cost is so cheap that most clients end up keeping it till the expiration date. But some decide to drop it as well. There's most of the clients don't need it, but they keep it because of superstition. They're afraid of, if I drop it today, that's when their clock's gonna end. So
right, sure. Why don't we take a couple more questions from our pre-submitted list? I'm 74 years old and I have a universal life insurance policy. Other than market conditions, can I lose value or can it lose value?
Yeah, so universal life policies, there's three types ultimately. There's fixed universal life contracts where the cash surrender value is in a fixed interest-bearing account. There's indexed universal life where it's based on some sort of market-based index, and then there's variable where it's based on mutual funds. There's three different types in that policy. All three of them are based on current insurance charges at your current age. So you're insuring the difference typically between the death benefit and the cash value. And as you get older, that cost of insurance rises. So if not funded appropriately, the cost of insurance could exceed the value gaining in the cash value in any of those types of universal life products. So it's very important in those type of universal life policies to get updated in-force illustrations to make sure that they, in a sense, the pro forma is still healthy. And if it's not healthy, how to modify them to perform as they're intended to be.
Great, great. What is the best coverage for long-term care?
Oh, this is that's a very difficult question. I will say this. So you have the very few scenarios. Occasionally we'll find a widow who has no children and just worried about themselves, and then still traditional long-term care insurance could make sense. But very rarely does the traditional long-term care insurance make sense in the current environment, because there's been a lot of products that have adapted to different insurance needs over the time. So the first thing we're doing, is we mentioned earlier, is looking, are there annuities with significant gains in after-tax vehicles that we can reposition for long-term care? Another thing we're looking at is if people have a lot of cash value life insurance, if we could potentially position that cash value policy to another cash value policy that could double dip on the death benefit for death or long-term care insurance. And then sometimes it's just saying, all right, well, let me just pay one time a premium and see. The most common is in those scenarios is hybrid products, again, which have a substantially more for long-term care, but you get your money back if you don't use it for long-term care via death benefit. Those are the most common solutions, but it's very personalized to your direct situation and needs. Good questions.
Yeah, you're right. It is one of the most difficult topics we face in helping to complete that financial picture for a client. You're exactly right. Why don't we go to one more? Roman, do you have one from the list?
Absolutely. All right. How are new technologies changing how insurance is underwritten?
Oh, I love this one. So in the old days when I first started, every insurance product practically, except for health insurance, needed a full physical. A lot of them needed EKGs, blood pressure, person coming to your house. Now the insurance is using AI, which is big data, to actually underwrite, in some cases, up to 10 million of insurance without even doing an exams. Now, that doesn't apply to most people, but they're looking at your prescription database checks. They're looking at your background checks. They're getting instant electronic medical records in some cases. So they're going behind the scenes to take all the data that's out there that you're obviously giving them permission to do for approvals that sometimes are within a few days, hours, or weeks. But the approval process and the ease of doing business is dramatically accelerating based on data. The one big thing that I warn you is transparency and honesty is the easiest way to get approved very quickly, because if the data finds something that you're not being 100% truthful, that's when you could expect the full-fledged audit of what does your health look like with a full exam, medical records, and anything and everything, because you lose your credibility.
Oh, that's good to know. Thank you.
Great. Yeah, great. Well, listen, that will wrap up our Q&A session for today. Ari, thank you. Thanks for carving out time to join us today. Thank you for lending your expertise, answering some questions, and hopefully providing folks today with a lot of good information and some help in answering their questions. So, folks, we'd like to thank you for joining us today as well. We hope you found it. We hope you found it helpful, and we also hope you join us for our next seminar, which is all about Medicare. That'll be presented on July 22nd. Same bat time, same bat channel here at Fort Pitt Capital Group. So again, thank you so much for carving time out of your day. Ari, thank you as well. And we'll see you next time on the Fort Pitt Capital webinar series.